Yeah, glad to be back.
Fine.
This is year 2 for Consensus here, right?
It is, and it's year 18 since I landed in Hong Kong and eventually became a permanent resident.
No kidding,
Yeah,
I didn't know
it's,
that. Okay.
The gray hair to show.
And now very timely because the discussion on stablecoins is a big hot topic here.
Isn't that fun? I came to Hong Kong as an entrepreneur in travel tech. We're talking Web 2 stuff, 2008, and frankly, there was not much of an entrepreneurship landscape and fertile soil for fintech startups and travel tech startups at the time. So I was a bit of a wimp.
And now things have changed.
Oh, things have changed. It's very good to be here and see how Hong Kong has embraced Web3, and from stablecoin regulations to other infrastructure. Also, the neobank licensing wave was already a good precursor to this 10 years ago, 6-7 years ago, and now we're really pushing forward. This is a good case of regulators not waiting for something else to happen, just do it.
Yeah, I think the writing's on the wall, right? And I think to just give like a quick background on me, so my name's Rich, I run our global crypto strategy at Google. We're probably one of the first large publicly traded companies in the US to start accepting stablecoins as a form of payment across a lot of our institutional clients. So this conversation about kind of where stablecoins are going and what the folks like Sergio are doing are leading at Anchorage, we started with the US, but that's certainly not where we'll finish, I think is the bottom line I want to make clear, is there's a ton of innovation happening in Southeast Asia. And I think actually stablecoins in many ways are uniquely positioned to solve a lot of the cross-border challenges that pop up in this region as opposed to just the domestic payment space.
Well, you're playing a good part of that transformation, and so are we. And for sake of introduction, I'm Sergio. I'm the head of stablecoins at Anchorage Digital. It's a financial platform for institutions. We're home to the first crypto bank licensed by the bank regulator in the US. And we are a stablecoin issuer as a service for clients like Tether, Western Union, OSL, Athena, that need a regulated, Genius-ready stablecoin to be transacting in global rails. So how do you use stablecoins today?
So today, our primary use case is really around solving payment frictions with third parties. So we started in this space probably around 21, 22. And one of the first things we heard from a number of crypto companies, and if folks have ever raised capital in this space, they know, is that a lot of the VCs were starting to fundraise crypto companies using stablecoins. And this created this really unique problem set because, of course, the crypto companies wanted stablecoins because it would make it very easy for them to engage in on-chain transactions or make trades, especially in the DeFi space, right? As opposed to getting dollars in a bank account, then loading it into some sort of an on-ramp and then going through that process. And so when we talked to them, the first thing that we heard was, behind people and behind, development costs, we're spending a lot of money on our core infrastructure. And it's really not a pleasant experience to go into crypto, have the stable coins, and then have to off-ramp into dollars and then pay a core service provider. And so for us, that was very clear that there was a problem that we could help solve. And at the time, it was also a great utility, right? Because I think most people were thinking about stablecoins as a mechanism for increasing velocity for people to trade crypto, which is true and is a great use case. But one of the things that we saw was that it actually became a great medium of exchange for many of what were small companies at the time, and now have naturally grown much larger, right? This includes like the large exchanges and some of the others. So that's how we started. And now we're thinking about, okay, what does it mean to have sort of the payments plumbing of Google? So not just pay-ins on stablecoins, but payouts. And so we recently announced a project where we're actually introducing stablecoins as a payout for YouTube creators. This is kind of like the killer use case that everyone talks about. And that's like the full life cycle. So we talk about getting payment in stablecoins and also doing payouts in stablecoins. And then there's custody, which you guys obviously know a lot about in the middle. So that's where we're heading now.
I like how you really see it end-to-end. The concept of on and off ramping is a necessary evil that we've all had to deal with at the interface of fiat and digital assets for the past few years and the first generation of stablecoins. But really where we should aim is to have a continuum from a payment to another payment to another payment, where the stablecoin keeps circulating, whether instead of being redeemed for cash and then filled up in a fractional reserve bank deposit back again on a fiat ledger, right? What's the point in issuing a stablecoin for it to be burned the next day? So I like the way you think of it as an onward payment system. Yeah, obviously at Anchorage we facilitate that type of infrastructure with custody. It's something that we started doing almost 10 years ago, and for the past 5 years under the supervision of the federal bank regulator. So it gave us a good perspective to understand how institutions can approach digital assets and do it safely. And when it comes to treasury management, we've seen all the client types, from crypto protocols to VCs to asset managers, traders, and now also other banks and banking institutions that are starting to understand that these stablecoins are here to stay. So there's no point in trying to burn them and get rid of them as soon as possible, but the whole point is take it, how do I use it now, how to deploy it in a vault, how do I convert it into a yield asset, how do I obtain rewards and have risk-free rate on it, how do I then use it for onward payments, how do I find a Nostro account in another bank. And so this is the circulation that really makes it happen magically. How do you do that in your corporation?
Baby steps.
Baby steps.
Look, the first conversation that we had with our treasury team, and if you think about Google's treasury, it's very unique, right? I think the latest quarterly report is a $120 billion cash position. We made over $400 billion in revenue last year. About half of that is actually coming offshore. So from our international businesses all over the world. So if you think about like sort of the central nervous system of Google Treasury, and this applies for other large multinational corporates, they have very complex and sophisticated processes right now to manage forms of payment, to manage FX risk, to manage trapped cash. And so for them, it was really just about understanding first that stablecoins were here to stay, and they had attributes around transactability, the one-to-one reserve, the velocity 24/7 aspects of it that were unique and different than what current Rails provided. And so that was like sort of the first step, is help them see the velocity, like actually experience that. And so we actually did a sort of like a penny test, which was the very first transaction. And I intentionally set up this war room that was going to be like an hour long. I like blocked out all this time, and I had all these treasury folks there, and these are really sharp people, and they're like, I'm going to make an hour of my time for the stablecoin stuff. And we did the penny test, and it was a 30-second exercise. And it hits, boom, USDC, we got it, okay. And everyone's like, wait, is that it? I was like, yeah, that's it. There's no more. We can wrap it up. That's how quickly it came in. And no matter how sophisticated they are around the traditional space, they are still used to dealing with legacy Rails. And this is every corporate treasury. So the most important thing is, show, don't tell, right? And start with those baby steps. And then over time, it's become very obvious where these conversations around trap cash, around FX risk hedging, stablecoins obviously have a unique set of characteristics that make them superior in many ways.
Yeah, you said earlier sophistication and complexity. That translates into cost. I mean, having thousands of bank accounts around the world and asset management accounts around the world, having to constantly operate between them and move assets and money and treasuries between them, wait for the settlement time, wait for the cutoffs. Just think about it. You're in Australia, you want to move money or clear dollars through a US bank, you have to wait for the Monday morning in New York, which is already your Monday evening to transact. So basically, at best, you're going to see the transaction initiate on Tuesday, at best, and then you have to wait for settlement time.
Right.
So this is really where you can make a difference. And what I usually say is that stablecoins are beautiful because they make three separate products converge into one single instrument: settlement network, a payment token, and a treasury instrument. And so having the three combined together really makes it possible to rearrange the building blocks and have those people in a room assist a 30-second operation that would have otherwise taken people all around the world to scramble to their own UIs, calls, and API calls, etc. So now that we have these three pieces together, and the same token that is kept at treasury for overnight yield, then can be also used for a payout on a PayPal creator in Egypt. Then you have some real magic there.
Yeah. So the transactability component, right, which is obviously the velocity and the borderlessness of it is a big thing. But to the point that you're making, for large corporates, having the ability to kind of collapse all three of those instruments is really unique. And so it does take that complexity that has taken time to develop, and it sort of truncates it into a very simple instrument. And I think, when we talk about stablecoin adoption with treasuries, I think there is this tendency as an industry to sort of almost gloss over a lot of the difficulties of onboarding this stuff. But ultimately, what I see happening is treasury teams, not necessarily like totally lifting and shifting all of their payments off of the traditional rails. I expect that they're going to now have another option in the set that they have today for particular types of use cases where stablecoins just outshine traditional rails or even traditional forms of payment. And the sort of maybe like the stepbrother of stablecoins, which is the tokenized deposit, is sort of like a half step there. And so I think when I talk to our treasury teams and when I talk to other corporates, right, other boards who are asking, how did Google do this? How do we get involved? I think what I explain to them is there's sort of a spectrum. Right now, almost everybody is on the left-hand side of the spectrum, which is they only use traditional rails. They're only using traditional forms of payment. And it's got the whole, closes at 4:30 p.m. and doesn't do overnight and isn't open on the weekends, which we are understanding is now just not adequate. And I sort of walk them through the tokenized deposit process, which is, some of your operating banks may issue a tokenized deposit, and that will look and feel to you just like the commercial bank money you use today with that banking partner. But it will come with some of the attributes of stablecoins, not all of them, but some of them. And then you have the stablecoin itself, right, moving on oftentimes public permissionless rails. And I think every corporate treasury department is going to have sophistication in each of these areas, not just for the playing defense and making sure that they're being capitally efficient, but also for some of the stuff that we've seen around the agentic space as well.
And from an infrastructure and issuance perspective, that beautiful spectrum can be further complicated or expanded into another subspectrum between the tokenized deposits and stablecoins. And this is where it's funny, because a few years ago, I was absolutely against tokenized deposits, considering just a bank liability on chain. But truly, if you think about it, now that stablecoins are partly backed as per regulations by deposits, then you can have a stablecoin that is 0 deposits within and a stablecoin that is 100 deposits within. Rulemaking to be finished by Genius, so let's see how it's going to go at the end of the year. But the spectrum is wide, and you can choose as a corporate or as a user, as a holder, between a spectrum of stablecoins that are made a little bit different within. And on one end, it's almost like a tokenized deposit. So this interface between the tokenized deposits and the stablecoin is going to be the solution for the elimination of the ramps.
Yeah.
Because at that point, you will be able to get into a traditional banking ledger system without having to pass through a hard fiat conversion.
Yeah. Yeah. No, it's definitely an and as opposed to an or. Mm-hmm. And I would tend to agree with you. I think a lot of the pushback on tokenized deposits, people didn't really understand what it meant, right? I think it was just this idea that it was this permission closed thing, and didn't understand the benefits that it would have for many of the traditional banking partners, and also probably didn't understand just the attributes of commercial bank money and why large enterprises want that certainty and actually will maybe be in some ways biased towards it. But I think now people are starting to see like, wait, okay, this is definitely not either or. In fact, as I would argue, as more stablecoin adoption is driven within, not just within the retail space, but within the institutional space, tokenized deposits will actually shine even a little bit brighter, to your point, because it will have different attributes, but it will still also be a step function improvement in how traditional payments works, right? I think that people saying that the bank is closed on a weekend, I think that's going to be a thing of the past.
And also, it makes banks more comfortable in entering digital assets, because then they can take part with their own products.
That's right.
And so far, it has always been, I mean, the narrative has mostly veered towards DeFi versus traditional finance. This is the proof that a traditional finance product can be on-chain to help DeFi products actually be healthier with the quality of bank backing, with the quality of rails, with the quality of custody, etc.
That's right. Yeah, I mean, we one of our larger partners. So we have a layer one that we call Universal Ledger that's focusing on this tokenized deposit solution set. And one of the larger customers is CME, and they just mentioned in their quarterly announcement, like they are looking to take advantage of this kind of tokenized deposit for clearing and settlement on the commodities exchange, right? Because cash is a means to an end, right? It's just simply a way to kind of keep track of essentially favors, right? I want to access a service, I need cash, I need to use that. It's not an end in and of itself. And so what we're seeing is that some of the folks who are seeing the promise around stablecoins actually like the tokenized deposit because it's a bit of a gateway drug, right? It can start there, and then of course, once they're moving 24/7, I think it's unlikely that they're going to say, I would actually prefer to go back to the Monday through Friday, 8:30 to 4:30 payment rail scheme, simply because it just doesn't work for modern business, right? If you think about all the exchanges going 24/7, nobody wants to bear the risk overnight of collateral that hasn't been settled, right?
No.
If you have an exchange trading, throughout the midnight or the nighttime zone. So I think that's like an area that's quite interesting. And then when we talk about agents, agents don't sleep. So if there's anything happening around agentic commerce, using traditional rails, well, you can't give an agent a bank account today, right? You can give an agent a crypto wallet. And so stablecoins become like almost machine-readable native payments.
You can at Anchorage, indeed.
Yeah. Well, you guys are a little different, though. You're special.
We're special.
Yeah. But I do think that that's like another area where people will start to realize that the traditional payment space is quite limiting for innovation, particularly the types that we're seeing. And ultimately, like more optionality in this space is going to be better. So I'm excited about that.
Yeah, talking about optionality, the final user of stablecoins is obviously retail that may or may not know that they have stablecoins in their wallet, but really need a solid money balance or dollar balance. Today, the distribution part has only really been proven by Tether at scale when it comes to stablecoins. We're seeing a second generation of stablecoins now with new entrants, with new propositions, with new platforms. How do you see that playing out? Specifically on the Google platform, which really, as a distributor, you may feel some pressure there on your choices.
Well, I think I feel like the last 5 years in crypto has taught us a lot, right? At one point in time, block space was this special thing. Now it's commodified. Mm-hmm. And so anyone can launch a layer one, but there are only certain layer ones that have managed to gather network effects. So it all kind of goes back to where we started. There's a bit of a symmetry here, which is blockchains were really sort of this like hack to get network effects very quickly and kind of solve this traditional cold start problem that people saw in the social media era in Web 2. And I think in many ways, stablecoin issuance, to some extent, will become commoditized. So folks will issue stablecoins. You will have some that are better than others, but by virtue of the regulatory license they have, or the reputational backing they have, or sort of the trust in the underlying custodian for the reserves. But ultimately, the thing that is going to win the day here is, do you have distribution? And I think that's where getting adoption from some of the larger corporates is going to be really important. It's one of the reasons why we started with pay-ins and have looked at payouts, because I think for there to be this sort of catalyst moment for adoption, you really need to drive that utility, and you need to do it at scale. It's not sufficient. It's just a handful of crypto natives. For stablecoins to really get to that moment of your real adoption, you need to go beyond crypto, abstract the way to use users, and become a better form of payment.
To better form of payment.
There you go. Thank you very much for having me.
Thank you for listening.